just to understand this correctly, if there's a rate increase and it's too much, and you guys don't have as much damage, there's not as much, let's say we have a few good years, then you guys will have to lower your rate eventually, right?
The way California law works, right? Yes, the way California law works, it says no rate shall be approved or remain in effect if it's inadequate, excessive, or unfairly discriminatory. So the Department of Insurance at any time is able to look at an insurance company's numbers and say, hey, we noticed that you've been making a lot of money. We think your rates are too high, and they can haul you into court and they can order you to lower your rates. And they have done that. So we, now what they don't normally do is say, hey, we think your rates are inadequate and we want to order you, we want to order your rates up so that you'll be more solvent so that you can insure more people. They don't focus on that side of the equation, as I noted earlier. Their job should be dual, to make sure there's enough money to insure everybody in California and also to make sure that the rates are not excessive.
So in a sense, the way the California insurance system works, consumers can have confidence that whatever rate they pay is regulated, and then the profits are limited.
Yes.
So the insurance companies are not taking a lot more than they should, because eventually, even if you have a good year, a few good years, you probably have to, somebody's going to monitor you guys' profits.
Well, that is what happens. And evidence of these rate and profit controls having an effect is just look at what the average premium is in California versus the rest of the country. We're not a high premium state. Now, I know people experiencing these big double-digit rate increases, it feels bad because their budget is thrown out of whack. But we should have had a bunch of small increases over the last 15 years, but we didn't. And so as a result, now these rate increases are coming in bigger chunks than they should be. But even with these rate increases, you look at a low-cost state like Louisiana, it costs on average $2,200 a year for homeowners insurance in Louisiana. Here it costs about $1,500, right, on average. Now, of course, someone's going to say, well, I live in a high-risk area, it costs me $3,000 or $4,000, and that's undoubtedly true. This is an average, because there's people in urban LA who are going to be paying $1,000. Because under our law, no rate shall be unfairly discriminatory. You're not allowed under California law to make one customer subsidize another customer, is the way the law works. So on average, though, California is a relatively low average premium state. And do we think it costs more to rebuild a home in Louisiana than it does in California? No, of course not. But yet their rates are demonstrably higher. Same with Texas, same with Florida, because they've been dealing with hurricane risk. You go to Colorado, they're just starting to have the fire problems we have, and their rates are much higher than California. So we just do not charge as much in California as in other states, and there's a consequence to that. Because remember, the department should be looking at both sides of this equation rather than just trying to push down rates. Now, I will say that this commissioner, I think he's been realistic about the situation we're in, and I think he has tried his best to balance the two poles here, make sure companies have enough money, but not too much. And so I give the current administration credit for at least trying to be sensible about modernizing an antiquated system and protecting the consumers while doing so. I wish we had this earlier. We didn't, but that's where we are. So we're in a situation where it feels to customers who are paying these huge increases, it feels to them like, oh my gosh, this is an outrageous price I'm paying, and rates are only going up. But then insurance companies look at this and say, but just look at the national numbers. We're nowhere near a high-cost state at this point.
Is it fair to say the previous years the insurance costs didn't go up because we didn't have major wildfires or major catastrophes, so the previous commissioner didn't think about that?
Well, we know he thought about it because we requested multiple times to update the regulations to make sure that in times of low fire risk, when we know what the future holds is going to be high fire risk, should we just wait and wait and wait till we allow rates to go up until there's a big fire and then say, oh, there's a big fire, now it justifies you to charge a bunch more? That's our current system. Our current system says, well, if you have 10 years of good luck and low fire, we're not going to let you raise your rates. even if you're saying, but I'm going into higher risk areas. I'm going into areas I know are going to burn in a hotter, drier future. The way our rules work now, you get no credit for that.
And we have developed in more higher risk areas.
Absolutely. So companies, they continue to grow in high risk areas, but yet because we had 10 years of relatively low fire activity before 2017, you couldn't raise your rates because that's the way our sort of feast or famine system works. If there's no fires, you can't justify higher rates. If there's a fire, you can justify enormously higher rates that you never would want to charge. The one thing I can say about our current system is it's always wrong. It's always producing a rate indication that's either too high or too low. And so what we've been advocating for over a decade is it doesn't matter if we have 5 years of low fire or 5 years of big fire. We should be looking ahead to what the future is going to be and have models that are sensitive enough to make sure that you have adequate rates during times of low fire activity. But after massive fires, your rates don't spike. And that's what forward-looking modeling does. It provides stability that we desperately need now.
So essentially, consumers need to know that their insurance rates should go up on a regular basis with inflation, whatever cost of rebuilding.
As any other good or service. I mean, what business in the United States is able to go for extended periods of time without increasing their prices? It doesn't make any sense. We don't ask that of any other business in the United States. And so if we have extended periods of time where companies cannot keep up with the costs of doing business, what are they going to do? They're going to react by taking the highest cost elements of their business and no longer serving them. And that's the situation we're in. This is utterly predictable, but fortunately, we can fix that.
Now, Rex, you were just testifying in D.C. about these insurance issues, right? Yeah. Can you tell us what's the perspective across the country about what's happening in California?
Yes, so this week I testified before the House Financial Services Committee, the subcommittee on housing and insurance, and they were really trying to get their arms around what's happening in California. And there, it did not feel as contentious as California feels. These were people of good faith just trying to understand what's going on and how can we help, what type of money needs to flow immediately, and then what should we do for the future. They were very focused on mitigation, what should be rules for hardening homes, what should be rules for making sure that your property is as safe as possible. Should there be rules for how communities rebuild back? Maxine Waters was asking, should we restrict where cities and counties are able to permit building? So we certainly got questions like that. And what materialized was really how hard the conversation is going to be about how we rebuild in Los Angeles. Do we just rebuild the way that we did, the way that we previously have done? The Los Angeles Times had an excellent historical article within the last week where they talked about, once upon a time there was the Bel Air fire and it burned through these hills, and the reaction was, hey, we need to be careful, we need to upgrade our building materials, and we need to not develop in some of these areas. Then over time, people forget there was a fire there. And you get new elected officials who say, yeah, we ought to allow development there. And so we just have built into a very dangerous environment. And it's not the insurance industry's position to say whether that was good or bad. It's our position, it's our job to say what's the consequences of those decisions. And price is the dominant signal there. And if folks want to live in a high brush area, well, it's probably going to result in a higher insurance cost. And my view is I think we ought to want that signal so people, they can make that their own decision, and then they can pay an appropriate price. And if the state won't let that price be charged by the insurance company, well, the insurance company is not going to do business there, and that person's going to have to go to the FAIR plan, or they're going to have to go to a non-admitted company.